$94.91. That's where WTI crude oil is trading right now, today, Thursday, March 12th, 2026. And if you think that number is just a line on a chart that doesn't affect you personally, I need you to pay very close attention to what I'm about to tell you. Because 12 days ago, the world changed. 12 days ago, the United States and Israel launched what the Pentagon is calling Operation Epic Fury, simultaneous strikes on Iranian targets. And since that morning on February 28th, crude oil has gone from $57 a barrel to knocking on the door of $100. That's a 51% increase in less than 2 weeks. Not in a year, not over a quarter, in 12 days. And I want you to sit with that number for a second, because the speed of this move is without modern precedent. The only thing that comes close is the 1990 Gulf War. The only thing. And even then, the price didn't move this fast. But here's what nobody is connecting for you, and this is why I made this video today. The oil price is the least of your problems. What's actually happening right now is that the Strait of Hormuz, the single most important 21-mile strip of water on the planet, has been effectively closed to commercial shipping for the first time in recorded history. And when that strait is closed, the price of oil isn't just oil prices go up. It's fertilizer, it's semiconductors, it's your grocery bill, it's your heating bill, it's your mortgage payment through inflation. It is the beating heart of the global economy, and right now that heart is in irregular rhythm. By the end of this video, you're going to understand exactly what's happening, why historians are already calling this the biggest oil supply shock since 1973, what the math says happens next, and what you can do right now to position yourself intelligently. Stay with me. Let me give you the real data first, because this is not opinion. This is documented fact. According to the U.S. Energy Information Administration, the Strait of Hormuz carried 20 million barrels of oil per day in 2024. That is 20% of all global petroleum consumption. It is 27% of all seaborne oil trade on planet Earth. And here's the thing, it's not just oil. Qatar ships 9.3 billion cubic feet of liquefied natural gas through that strait every single day. That's roughly 20% of all globally traded LNG. So when Iran's IRGC started firing on commercial vessels and the UK maritime trade operations confirmed that what used to be 138 ships per day transiting that choke point is now a trickle, we're not just talking about gas prices. We're talking about fertilizer. We're talking about plastics. We're talking about the supply chain inputs for literally everything. Now let me show you the paper trail because I want you to be able to verify every single thing I'm saying. The EIA released its short-term energy outlook on March 10th, 2 days ago. Their own words. Brent settled at $94 per barrel on March 9th, up about 50% from the beginning of the year and the highest since September 2023. Crude oil prices have risen as petroleum shipments through the Strait of Hormuz have fallen, and some Middle East oil production has been shut in. That's the government's own energy agency telling you exactly what's happening. Brent crude, the global benchmark, traded at $100.37 this morning, according to investing.com data. WTI, the American benchmark, hit $94.91 overnight before pulling back slightly. And Goldman Sachs today, March 12th, raised their Q4 2026 price forecast for WTI to $67 a barrel in their base case, and their analyst added this line that should stop you cold. Spot prices are likely to exceed their 2008 peak of $147 if flows remain depressed through March. That's Goldman Sachs, in writing, today. Now before I go further, quick note for those of you who aren't subscribed yet. My analytics show that about 3 out of 4 people watching this video right now aren't subscribed. If this kind of data-driven, source-backed analysis is cutting through the noise for you today, hit subscribe. That's literally how I know who the committed community is, and it helps the algorithm put this in front of more people who need to understand what's actually happening. Now let me show you the historical pattern, because this is where it gets important. This is not the first time the world has confronted a Strait of Hormuz crisis, but it is the first time the strait has actually been closed. And understanding the 3 times this threat surfaced before, and what happened to prices, to inflation, to everyday people's lives, is going to tell you exactly what to watch for next. The first time was October 1973. Arab members of OPEC launched an oil embargo against the United States and its allies. Now here's the critical comparison. The 1973 embargo removed approximately 4.4 million barrels per day from global supply. That was about 7% of world consumption at the time. The result? Oil prices went up 300%, from $3 a barrel to $12 a barrel. The U.S. economy fell into recession, gas lines wrapped around city blocks, A national speed limit was imposed, and the combined shock of stagnation and inflation, what economists came to call stagflation, was considered so impossible before that crisis that textbooks had to be rewritten. Now think about what I just told you. The 1973 embargo disrupted 7% of global supply. What's happening right now is threatening 20% of global supply. That's nearly 3 times more volume. And this time, it isn't just an embargo, it's a shooting war, with mines being laid in the shipping channel, tankers being struck by projectiles, and Iran's IRGC announcing this week, on the record, that not 1 liter of oil will pass through the Strait of Hormuz until U.S. and Israeli attacks stop. And their spokesperson went further. You will not be able to artificially lower the price of oil. Expect oil at $200 per barrel. That's not hyperbole from a fringe source. That's a statement from Iran's Khatam al-Anbiya military headquarters, reported by Al Jazeera on March 11th, yesterday. The second inflection point was 1979. The Iranian Revolution collapsed 5 to 6 million barrels per day of Iranian production. Oil doubled again, up 200%. The toxic combination of that shock with the lingering effects of 1973 produced the worst inflation in American post-war history, and ultimately forced the Federal Reserve, under Paul Volcker, to raise interest rates to 20% to kill inflation. 20%. That caused the deepest recession since the Great Depression. This is the pattern: energy shock, inflation, central bank response, recession. The third moment was the 1980s Iran-Iraq War, when both sides started attacking tankers in what became known as the Tanker War. The world had to convoy ships through the Gulf. Insurance became nearly unavailable. That conflict disrupted roughly 4 million barrels per day. Every single time there's been a serious threat to Gulf oil, not even an actual closure, just a threat, prices have exploded and economies have bent. So what do you think is happening right now when the strait is actually, physically, effectively closed? Here's what makes this moment different from all 3 of those historical episodes, and here's where the evidence gets truly alarming. The bypass capacity simply isn't there. Let me prove that to you mathematically. Saudi Arabia has its east-west pipeline, which runs from the Gulf Coast to the Red Sea port of Yanbu. The UAE has the Abu Dhabi crude oil pipeline to Fujairah. Total available bypass capacity? The EIA estimates about 2.6 million barrels per day of currently available bypass capacity, with a theoretical ceiling of maybe 5.5 million barrels per day if you push those systems hard. But remember, the strait normally carries 20 million barrels per day. Even in the absolute best-case bypass scenario, you're replacing less than 30% of disrupted flows. You cannot plug that gap. It is mathematically impossible in the short term. And the IEA, the International Energy Agency, the body of 31 developed world countries that exists precisely for moments like this, just agreed to the largest emergency reserve release in history. 400 million barrels. Record-setting. Unprecedented. And analysts are already telling you it buys a few days. That's it. Sasha Foss, energy market analyst at Marex, told CNBC on Wednesday, "These releases of the IEA's stocks really buys us a few days, but in reality, really it all depends on the opening of the Strait of Hormuz. This conflict needs to end by the end of the week. Otherwise, we'll see oil prices spike back up over $100. Well, it's Thursday. It didn't end. Iraq, the second biggest OPEC producer, has effectively collapsed its production output because it can't export through the strait. Kuwait announced precautionary cuts to production and refinery output. Gulf producers are running out of storage because oil is piling up with nowhere to go. WTI hit $119.48 as recently as Monday before pulling back. And the 52-week trading range for WTI futures right now, according to investing.com, is $54.98 on the low end to $119.48 on the high end, in less than 2 months. Now here's where it gets worse, and I mean truly worse. This isn't just an oil crisis. I want to connect some dots that the mainstream media is covering separately when they really belong in the same sentence. The Atlantic's energy economics writer Derek Thompson published a piece yesterday quoting geopolitical energy expert Rachel Ziemba, and she said something that should be bolded everywhere. The Strait of Hormuz doesn't just carry oil, it carries 30% of global seaborne fertilizer. It carries a growing percentage of global container traffic. 40% of global urea shipments from the Middle East, urea being a critical nitrogen-based fertilizer, are effectively stranded outside the strait right now. If fertilizer can't move, it doesn't get applied to fields. If it doesn't get applied to fields, food production declines. The UN World Food Programme has already warned that the 2026 military escalation in Iran is driving significant long-term increases in global food prices. We're not talking about oil prices here anymore. We're talking about whether grocery store shelves stay stocked. We're talking about whether developing nations can afford to feed their populations. And there's more. Japan gets 70% of its oil imports through the Strait of Hormuz. China gets approximately 5.4 million barrels of crude per day through that choke point. South Korea, India, the entire industrialized Asian economy runs on oil that passes through that 21-mile corridor. Iran has already sent 11.7 million barrels through to China since the war began, tankers that largely went dark, switching off their tracking systems to evade detection. TankerTrackers.com, which uses satellite imagery to monitor vessels that have disabled their transponders, confirmed this to CNBC on Tuesday. So China is quietly getting oil. Everyone else is competing for increasingly scarce alternatives. Let me show you the smoking gun on this one, because there's a piece of this story that I haven't seen anyone else connect clearly. Between February 15th and February 20th, that's 2 weeks before the war started on February 28th, Iran increased its oil exports to 3 times their normal rate and simultaneously reduced its oil storage. 3 times the normal rate. Think about what that means. They were liquidating their reserves before the conflict started. They knew. The war didn't catch Iran off guard. They positioned themselves, financially, strategically, before the first bomb fell. And on February 27th, the day before the strikes began, Oman's foreign minister publicly announced that a breakthrough had been reached, that Iran had agreed to nuclear terms, that peace was within reach. And then the very next morning, Operation Epic Fury. So either the peace talks were a feint to lower Iran's guard, or someone was lying about the state of negotiations. Either way, you had at least one major party in that room who knew what was about to happen, and Iran prepared its oil exports accordingly. Now, is that evidence of absolute foreknowledge? That's for historians to debate. But the timing of Iran pumping out 3 times its normal oil volume in the days before war is not a coincidence. It is a documented market event recorded by satellite imagery firms, and it raises a serious question. Who else knew? Because oil options markets showed unusual activity in the days before the strikes. But let's stay with what's verifiable. Here's the disconnect that I find most fascinating from a market perspective, and it's something that gold and silver traders know very well. When gold surged past $5,400 an ounce on March 2nd, within days of the war starting, and then crashed back nearly 6% to around $5,018 as investors rushed to cash, that was rational. You can explain that. You can explain why the dollar surged simultaneously, making dollar-priced assets temporarily less attractive. What you can't explain with normal market logic is the oil market's behavior on Tuesday, March 10th. U.S. Energy Secretary Chris Wright posted on social media that the U.S. Navy had escorted an oil tanker through the Strait of Hormuz. Oil prices cratered. Immediately. Within hours, White House Press Secretary Caroline Leavitt told reporters the Navy had not escorted a tanker or a vessel at this time. The post was deleted, and oil prices surged right back. What you just watched is a market that is so starved for good news, so primed to act on any signal of Hormuz normalization, that a deleted social media post caused a multi-percentage point swing in crude prices in both directions within a single afternoon. That tells you something critical about where sentiment is right now. The market wants this to be over. It will price in any peace signal instantly and aggressively. And that means when peace does come, if it comes, you're going to see a very rapid reversal in oil prices, which has enormous implications for how you think about this. Now let me bring this down to earth. What does all of this actually mean for you? Because I know some of you watching this are holding energy stocks. Some of you are looking at your gasoline bills and your heating bills and wondering how high this goes. Some of you are worried about the broader economy, and some of you are thinking about gold and silver as a hedge against all of this. Let me walk through each of these practically, and I want to be clear, this is not financial advice. I'm not your financial advisor, and you should always do your own research and consult with a qualified professional before making any investment decisions. But here's the framework I think about. First, energy itself. Aviation fuel is trading at roughly double January 2026 levels, according to Reuters reporting today. Air New Zealand just announced it's cutting 5% of its flights because of surging fuel costs. This isn't abstract. This is arriving in the form of higher airline tickets, higher shipping costs, higher prices for anything that moves. If you run a business with significant logistics costs, right now is the time to be doing whatever hedging or forward contracting you have the ability to do, because the near-term outlook from every credible source, Goldman, EIA, IEA, assumes elevated prices for at minimum the next 30 to 60 days. Second, inflation. The February CPI came in at 2.4% year over year, released today. And markets are looking at that number and understanding that it's about to get complicated. The Fed is in an impossible position. If oil stays elevated, inflation reaccelerates. If the Fed responds by holding rates higher for longer, which Bloomberg data shows markets are now pricing in, pushing the first expected rate cut to September, that creates additional economic headwinds. The classic 1970s trap. Energy shock forces inflation higher, central bank can't cut rates to stimulate the economy, growth suffers. Third, gold and silver. Gold today, according to multiple sources, is sitting around $5,151 to $5,177 after a significant pullback from its $5,400 plus peak. Silver is holding near $84 to $85 per ounce. And here's the interesting analytical note from Bar Charts commodities expert Jim Wyckoff, published yesterday. He pointed out that the war in Iran, one of the biggest geopolitical events in decades, has not moved gold and silver as dramatically as you might expect. And he identified this as potentially bearish, suggesting that if markets can't rally hard on extremely bullish news for safe haven assets, bulls may be exhausted. That's a legitimate point worth considering on the short term. But JP Morgan's longer-term target for gold remains above $6,000 by end 2026, BNP Paribas similarly. The structural bull case for gold, de-dollarization, central bank buying, deficit spending, inflation, doesn't change because of short-term volatility. Fourth, the shale question. You might be asking, can American shale production just ride to the rescue here? U.S. production is expected to average 13.6 million barrels per day in 2026, according to the EIA, a record. But oilprice.com made a point this week that's worth your attention. Despite higher prices, U.S. shale producers are not rushing to increase drilling. They're prioritizing capital discipline and assuming the disruption may be temporary. Shale wells can be brought online relatively quickly, but not in the time frame that matters for the next 30 days. And the Hormuz problem is about transportation, not production. American oil can't replace Persian Gulf oil in Asian markets efficiently by geography alone. Fifth, the recession question. Analysts quoted in a long yield analysis published before the war calculated that a Hormuz closure lasting more than 30 days would push global recession probability above 75%. GDP contractions of 1.5 to 3% are modeled for major importing economies under a 3-month closure scenario. We're on day 12 of a shooting war with no clear end date. Israel's defense minister said on Wednesday the operation will continue without any time limit. Trump said the war may end soon because there's practically nothing left to bomb. But those mixed messages from the White House are exactly what's keeping markets volatile. Here's the thing I want you to really internalize because this is the part that gets lost in the daily news cycle. Every single historical oil shock, 1973, 1979, the 1980s tanker war, the 1990 Gulf War, had one thing in common with what's happening right now. In the moment, the disruption always looked like it would resolve quickly. In 1973, people thought the embargo would last a few weeks. In 1979, the Iranian Revolution looked like it would stabilize. Every time, the initial market reaction was shock, followed by partial recovery, followed by people saying, okay, it's probably going to be fine. And then it wasn't fine. The second, third, fourth order effects took months to fully materialize, in supply chains, in inflation statistics, in economic output. The damage always lagged the event by enough that people got comfortable before it hit them. The question isn't whether crude oil at $95 today is hurting you. The question is what crude oil averaging $90, $100 for the next 6 months does to inflation, to interest rates, to your purchasing power, to the equity markets, to corporate margins, to every company that ships anything using diesel. That's the actual question. And the historical record on that question is not ambiguous. It hurts. It hurts a lot. And the people who were positioned for it, who held energy exposure, who had inflation hedges, who didn't have to sell assets at the bottom, did dramatically better than people who were surprised. I'm not telling you what to do. I'm telling you what the data says about what has happened in comparable moments in history. Let me show you what to watch in the coming days and weeks because this is a developing situation, and the key data points that will determine whether oil goes to $70 or to $140 are actually knowable in advance. Watch the Strait of Hormuz itself. Specifically, watch whether insurance companies begin treating transit as economically viable again. That's the real signal. Not what Trump says, not what Iran's foreign ministry says. When Lloyd's of London and the other major war risk insurers start re-underwriting Hormuz transits at reasonable premiums, that's the market telling you the danger is subsiding. Right now, most major shipping and tanker companies have suspended voluntary transits entirely. That's the real closure. Not a military blockade, but a commercial one driven by insurance. Watch the IEA reserve release. The 400 million barrels they've committed to releasing is significant. But as Goldman Sachs noted today, there's a logistical limit of about 3 million barrels per day on how fast OECD strategic reserves can physically be drawn down and delivered. So even the record emergency release is a small band-aid on a 20 million barrel per day wound if the strait stays closed. Watch the Fed's language. If energy-driven inflation picks up in March's data, and it will, watch whether the Fed signals it's willing to hold rates steady through Q3, or whether they decide that a war-driven supply shock is transitory and act preemptively. Their choice on that will determine a huge amount about what happens to gold, to bonds, to equities. Watch Russia. This often gets missed. Russia stands to benefit from every barrel that doesn't flow through Hormuz. Higher oil prices refill the Kremlin's war chest. A Western security analyst told CNN this week that Russia is giving Iran specific advice on drone tactics against Gulf targets. Russia profits from the disruption even while claiming neutrality. And the Trump administration is reportedly considering reducing Russian oil sanctions to help ease crude prices. A strategic gift to Moscow if it happens. And finally, watch the political clock in Washington. Trump says the war is ahead of schedule. Israel says there's no time limit. Those two positions are not compatible. At some point, the economic pain of oil at $100, airline ticket surges, gas prices spiking, and inflation reaccelerating will create political pressure domestically that nobody in Washington can ignore. Midterm elections are on the horizon. A president who promised energy dominance delivering $5 gas to the American consumer has a problem. That political pressure is eventually going to accelerate toward a resolution, or an escalation that makes everything worse. Let me bring this full circle because I started this video with a number, $94.91. That's where WTI closed overnight. And I told you that number wasn't just a data point, it's a signal. 12 days ago, crude oil was $57. Analysts at JP Morgan were forecasting a structural oversupply that would keep oil near $60 for most of 2026. The EIA was projecting growing inventories. OPEC Plus was talking about unwinding production cuts. The whole narrative was that oil was the forgotten commodity in a world transitioning to renewables. And then February 28th happened. And in 12 days, we've traveled 53 years backward in history to 1973. For the first time ever, not theoretically actually, the Strait of Hormuz is effectively closed. The largest emergency oil reserve release in human history has been announced, and analysts are saying it buys a few days. Qatar's energy minister warned that if this continues, other Gulf producers may declare force majeure and halt exports entirely, and said it could bring down economies of the world. Those are not fringe voices. That is the energy minister of Qatar, the world's second-largest LNG exporter. The people who were hurt worst in 1973 were not the ones who didn't understand energy markets. They were ordinary people who had no idea that a 21-mile strip of water in the Persian Gulf could double their heating bill, put their factory out of business, or cause the central bank to raise interest rates until their mortgage became unpayable. The warning signs were there. The experts who studied history saw it coming, but it didn't feel urgent until it was. The signs are there right now. They're documented. They're in the EIA report, in the Goldman research note, in the IRGC's own statements, in the satellite imagery of tankers going dark in the Gulf of Oman. The only question, and this is always the only question at moments like this, is whether you're going to be the person who looked at it clearly and positioned accordingly, or the person who figured it out 6 months later when it was already in the rearview mirror. I want you to be the first person. That's why I made this video. Drop a comment below and tell me, where do you think crude oil is heading over the next 30 days? Are you in the $70 camp if the strait opens, or the $120 plus camp if this drags on? I read every single comment on this channel. Your perspective genuinely shapes what I cover next, and in a situation this fast-moving, I want to know what you're seeing and thinking. If you haven't subscribed yet, please do. This channel exists to cut through the noise with real data at exactly the moments when the noise is loudest. And right now, the noise is very loud. I'll see you in the next one. Be careful out there.